started out of respect for everyone's time. It's good to be back with everyone. I was on vacation for 2 weeks, and so we're back for lesson 5 of the Kingdom Mastermind. The goal being, after these 10 sessions, the goal is for everyone to have a strategy and a plan to become financially whole. So without further ado, I'm going to go ahead and proceed tonight. And as you know, the motto of this lesson, or these series of lessons, is building the kingdom of God one family at a time. So let's go ahead and proceed. Every week we start by doing our wealth affirmations. Our wealth affirmations are: I am worthy of having more wealth. Financial freedom is my birthright. Money comes to me easily and effortlessly. Wealth constantly flows into my life. My actions create constant prosperity. I am grateful to be financially free. So those are wealth affirmations, because we know the scriptures does teach that whatsoever a person thinks in their heart, so it becomes. So our thoughts become things. So if we constantly focus on affirming our wealth, then we know that's exactly what will manifest as our reality. So I like to make sure we're repeating those every week, and I encourage you to repeat those every day. So to date, we've covered 4 lessons, and we're on lesson 5. So to date, this is what should have occurred, or these are the lessons that we went over. You reviewed 3 months of spending. You looked at your credit card accounts, you looked at your bank statements for 3 months, and you were able to see exactly where your dollars were going. You saw what was going toward bills and utilities, and you saw what was going toward personal spending. So that was the first thing that we looked at, is tracking your dollars. Secondly, you should have automated your fixed expenses. So all of your bills and utilities, they should have been linked to a checking account. And I asked you to create 4 separate accounts: 2 checking accounts and 2 savings accounts. The first checking account is where all of your funds should be arriving. So all of your income goes into this first checking account. And the second checking account was created for your bills and your utilities, and that was to be automated. Your your first savings account was for your emergency savings account. We talked about creating 3 months. So based on your bills and your utilities, you looked at exactly how much that cost you per month, and that is the amount that you use to calculate your emergency savings account. 3 months of your bills and utilities goes into your emergency savings account. And once you had the 3 months accumulated in your savings account, that first savings account, that second savings account would then be created, and that was your goal savings account. Also, we talked on week 3 about a debt elimination plan. That debt elimination plan, using the snowball method, you are to identify your debts, list them in order of least to greatest, smallest to largest. And you were to take on debt number 1 and put all of your additional income into paying that debt off, along with the minimum payment. Once that debt was paid off, you were then to focus on debt number 2, taking the money that you were paying on debt number 1 and focus it all on debt number 2. And you were to continue to use that strategy until all of your debts were paid. So that's a strategy that will be put in place, but it's a long-term strategy until you are debt-free. Number 4, we talked about credit repair. I provided you with the strategies to increase your credit score. I showed you how the credit reporting bureaus calculate your credit score based on those 5 areas. We looked at payment history. We looked at a mix of credit. So all of the things that they use with their algorithm to calculate your score, we looked at that and discussed the strategies in order for you to increase your credit score. A family member of mine that used those same strategies went from a 640, now they're at a 710, and the goal is for them to be at a 750 hopefully by the end of this year or definitely by January. So we discussed those strategies last session, and that was session number 4. So now today we're moving ahead to session number 5, and we're going to talk about living a tax deductible lifestyle. So let's talk about taxes, because again, when you're talking about becoming debt free, not only do you want to be debt free, but you want to make sure that you're minimizing your tax liability and that you're using those dollars to redistribute them toward debt elimination or toward building wealth through investment strategies. And we'll talk about investment strategies in the weeks to come. But let's look at how the IRS collects taxes. When you look at the Internal Revenue Service, look at A. Individual income tax makes up 55% of all taxes collected by the Internal Revenue Service. Individual income taxes. So that's W-2 employees, that's excise tax. So when you look, or any type of income tax, whether it's from your trust, whether it's from your estate, any income that's being generated makes up 55% of the taxes collected by the Internal Revenue Service. But the majority of that is W-2 wage earning employees. Business taxes only make up 10%. Business owners make up 10% of the taxes collected by the Internal Revenue Service. Who are some businesses? Think about this now. W-2 wage earning employees pay up to 55%, but businesses pay 10%. Businesses are your Apple, your Microsoft, your Amazon, your Tesla. The IRS collects 10% from these businesses, but 55% of the taxes they collect are from everyday 9-to-5 workers. So that should trigger something right now in your mind and say, wow, I really need to think about launching or creating a business to minimize tax liability. So other taxes, those are like your gift taxes, your estate taxes, excise taxes, etc. 35%. And I pulled this directly from the IRS. I pulled this directly from the IRS database, because we have some other folks coming in. So I pulled this right from the IRS database. When you look at the IRS data book, I want you to look at, and hopefully you can see my screen. This is the total amount of taxes collected by the Internal Revenue Service. 2.5 trillion. So this is trillion. $2.5 trillion. It goes from calendar year 2012 all the way up to calendar year 2021. So you can see each year it goes up. So 2021, it was a little over $4 trillion. But now look at this green line. If you look at the green line, this makes up your individual, your W-2, all income received makes up the green line. So that is, as of 2021, that's almost $2.5 trillion. Other, as we shared with you, the other includes your estate and gift and excise tax forms, right? Makes up the other. But look at this, who pays the lowest? When you look at the least amount of taxes paid, it comes from who? Businesses. The least amount. That's why I'm sharing with you that with this financial strategy that we're employing or that we're taking on, it's necessary for you to really think about creating a business. And I'm going to talk about that because businesses pay the least amount of taxes. And this is not Osceola's word. This is taken straight from the IRS data book. So let's talk about tax planning. The goal is to use every tax deduction strategy that you're legally entitled to. That's what I want you to start thinking about. Utilizing every tax deduction strategy that you're legally entitled to use. Now, look at this. Most of us use a tax accountant. I want you to think about how you do taxes every year. Generally, at the end of the year, you go from January to December. After December, you enter into the new calendar year with the month of January, waiting for your employer to send you your W-2. They have until January the 31st. January the 31st, you receive your W-2, and then what happens? In February, you reach out to a tax accountant or a tax service, or you purchase a TurboTax or some software, and you begin to start completing your tax forms. Then you have until, depending on the government, because with this pandemic, dates have been changing, but you have until April, the middle or end of April, to submit your taxes to the Internal Revenue Service. And what happens is when you meet with your tax accountant or you enter your data into that tax software, you're looking back on all of your receipts. You're looking back on all of the deductions that you qualified for. And then you're giving them to that accountant or you're entering them into that software. That's being reactive. That's the wrong way to go about tax planning. The goal is for you, let's say January 2023. The goal is to look at all of the deductions that you qualify for that calendar year of 2023, and position yourself to start taking advantage of every one of those deductions from January to December. Then when you meet with your tax professional or you purchase your tax software, you know that for 12 months, January to December, you've maximized all of the deductions that you were entitled to, thereby minimizing your tax liability. That's how the wealthy handle taxes. They don't wait until the end of the year and look back and see what they qualified for. They make sure that in January, they know exactly what they qualify for, and they position themselves and their businesses to take advantage of those deductions all 12 months of the calendar year. That's the approach that we want to take. And if you have any questions, by all means, please place them in the chat, and I want to address them as we're moving along. So the goal for this session is to learn how to make your lifestyle tax deductible. Everything you do should be tax deductible. If not, the majority of what you do should be tax deductible. Now listen to this. The tax code has over 75,000 pages of tax code. About 50 pages advise the consumer on paying taxes. So out of those 75,000 pages, 50 pages are used to tell you how to pay your taxes. Please mute yourself if that's your background. So 50 pages advise the consumer on how to pay their taxes. The other or remaining pages tell you how to avoid paying taxes legally. So this is not tax evasion, this is tax avoidance. Learning how to use the tax code to avoid paying more taxes than you're legally obligated to pay. One of the key strategies is to start a home-based business. I cannot emphasize that enough. One of the key strategies to minimize tax liability is to start a home-based business. Now, it's been estimated that there are over 30 million small businesses in the United States. 80% of those small businesses, listen to this, 80% have no employees. That means these are sole proprietorships owned by one person. 80% of the 30 million small businesses in this country have no employees. Think about that. Now, with starting a home-based business, you have the opportunity to deduct up to $5,000 of startup costs in the year that you start your business. So if there are startup costs, I don't know, you purchase a domain name, you create a website, you get business cards, whatever the expenses are, you're able to deduct up to $5,000 to start your home-based business. And remember, you're starting this business, why? Because businesses pay the least amount of taxes collected by the Internal Revenue Service, and you want to be in that group. Now, under the Tax Cuts and Jobs Act of 2017, home office deduction for employees have been suspended for 2018 through 2025. That means if you work from home, you can't claim a home office. So if you're an employee and you work from home, you can't claim any deductions for working from home as an employee. Now listen to the second paragraph. Those who are self-employed, have their own business, self-employed entrepreneurs, and working out of their homes may be eligible for a tax break. People who work remotely and get a W-2, they don't qualify. I just shared it with you. If you are a W-2 wage earner employee and your boss has you working from home, you cannot claim the home office deduction. If you are self-employed, you create a home-based business and you work for yourself as an entrepreneur through this home-based business, you can qualify for that tax deduction. Now, here's the good news. You can qualify for a home office deduction if you're self-employed, I just shared that, as long as you meet certain tax law requirements. So in order for you to have a home-based business and qualify for the deduction, there are still some things or criteria that you must meet. So the question I ask is, who is able to claim the home office tax deduction? And everybody on this call, I want you to create a home-based business. I'm saying that tonight. I want everybody on this call to create a home-based business, even if that home-based business is used to minimize your tax liability, to give you deductions that you can use to offset your tax liability, but also so that you can improve your station of living and start living a tax-deductible lifestyle. Now, determining if you qualify under the IRS home office rules to write off your home office expenses on your income taxes is not simple. Did you hear that? It's not simple to write off your home-based office as a deductible expense. Taxpayers must meet specific requirements to claim home expenses as a deduction. The IRS has specific rules that details who qualifies for these deductions. So the IRS, they have certain requirements or certain litmus tests that you must pass in order to qualify as a home-based business who qualifies for tax deductions. You should not only take the home office deduction if you meet every requirement, but you also have to prove eligibility in case you're audited. Nobody wants to go through an IRS audit. So you must make sure that you meet the litmus tests of being a home-based business if you're going to apply for those tax deductions. And yes, I want you to apply for every single tax deduction. So how do we do that? Now, the IRS has these requirements, especially if they audit you, they're going to make sure that you meet these requirements, but there's some exceptions to the rule, as with everything. Here's the exception. I want to make sure I'm positioning you properly. Here's the exception. Look at this. Storage of inventory or product samples. If you use part of your home for storage of inventory or product samples, you can deduct expenses for the business use of your home without meeting the exclusive use tests. So all of those requirements that the IRS requires of home-based businesses, you can bypass or skip all of that if you use part of your home for storage of inventory or product samples. So what are you saying, Osceola? You need to have a home-based business that provides you with inventory or samples that you can place in your home in a separate space, thereby qualifying you automatically as a home-based business. I hope you're following me. So if you have a home-based business that provides you with inventory or product samples, you automatically qualify. Look at this, without meeting the exclusive use test of the IRS. That's how we're going to bypass it. We're going to have you create a home-based business that provides you with products or inventory, and you are automatically qualified to become a home-based business and the deductions associated with it. Now that you have this home-based business, and we're going to talk a little bit about that, but now that you have a home-based business, because I'm speaking it into existence, you are eligible to apply for certain deductions. So let's look at a few expenses that you spend money on every month anyway, because I want you to claim deductions and make your lifestyle tax deductible based on things that you do anyway. So everybody on the line, I'm sure, has a cell phone. Everybody on the call, I'm sure, travel. And I'm not talking about vacations. I'm talking about everyday travel. eating out with friends, we all eat out. You have either rent or mortgage that you pay on a monthly basis. As an employee, individuals don't receive tax benefits from these expenses. So your 9 to 5 or your W-2, you are not able to deduct these expenses as a W-2 wage earner employee. However, with a home-based business, a portion of these expenses may become deductible. So you're going to qualify for deductions on things that you do every day simply because you've now created a home-based business. So let's look at your cell phone. You don't need to buy a new cell phone for your business. You can use your current cell phone. The only thing is that you have to figure out the percentage that you use that phone for business. So I want you to get you a Google Voice account, and that's a separate telephone number associated with your cell phone, and make that your business line and use it for business and deduct at least half of your cell phone expenses because you're going to be using that for business. So whenever you talk to your friends, whenever you talk to your family, make sure part of that conversation has to do with your business. And now you can deduct at least half of your cell phone bill because it's being used for business expenses. Any questions about that? So that's for your cell phone. Now watch this. Let's talk about travel. The IRS has a travel method. It's called the IRS method. The government gives you 58.5% deduction for calendar year 2022. And that's for every mile that you drive for business purposes. Now, if you have a home-based business and you leave your home-based business, guess what? You're leaving your principal place of business to travel somewhere. Everywhere you travel, you should make that business travel unless you're traveling from your home to your 9 to 5. If you're traveling from your home to your primary place of employment, you cannot deduct that as a business expense. But if you're traveling from your home and you travel to Starbucks in the morning before you go to your place of employ, make sure you travel there and your intent is to discuss business with someone at Starbucks, even if it's the person that's making your coffee. You're going to share your business with them, leave them with a business card, etc. If you're going to the grocery store, everything that you do now will be for the purpose of introducing your business, and you will be recording that as mileage. And I'm going to go into some additional travel information, but make everything that you do a travel expense. So when you leave your home-based business and you stop somewhere, before you go to your primary place of employ, you're stopping there to discuss your business, and you are writing that expense off. Now, I want you to look into your cell phone, and you have a Play Store, App Store, and they have mileage trackers. You want to look at the free mileage trackers. You want to put that mileage tracker on your cell phone so that it tracks your mileage. So that every day, wherever you're driving to outside of your primary place of employment, you're going to track that mileage, or it will track the mileage for you. You just have to make sure the app is turned on. At the end of the year, you will produce that document for your tax accountant. 58.5 cents, you will receive that for every business mile that you traveled for the calendar year. And that's a tax deductible expense. Why? Because you created a home-based business. Now, what about meals? Look at what the IRS says about meals. Meals with a prospect or client are 100% tax deductible for calendar year 2022. And the next calendar year, it's going to drop to 50%. But for the remainder of 2022, it's 100%. Now, here's the litmus test. You must have the appointment set up in advance. So let's say you're going out with your girlfriends. You now have a home-based business. You are going to email your friends confirming the dinner date and that you're going to discuss your business. I have a home-based business. I would like to share this with you ladies. Let's do it over dinner at such and such place at this time. Now you have a documented email. When you go there over dinner, you will discuss your business. That meal just became what? 100% tax deductible. If you go out with your family, it's the same exact thing. You've got to learn to start documenting your dining. Document your dining so that it becomes 100% tax deductible. All of these tax deductions are minimizing your tax liability at the end of the year. So here's another part of the Internal Revenue Code. If you go out with a client and they bring their significant other, whether it's a wife or girlfriend, doesn't matter, you can also bring your significant other and the entire meal becomes tax deductible. So if they bring their significant other, you can bring yours. If they don't, then you don't bring yours. But if they're going to bring their wife or companion, you can bring your spouse or companion as well. Any questions about that? Now let's talk about the home-based business. With the home-based business, this is how the Internal Revenue Service looks at you taking a deduction for your home-based office, whether it's a home, whether you have a mortgage, or whether you're renting an apartment. The IRS created a very simple way for you to claim a home office. You get a deduction of $5 a square foot up to 300 square feet. Let me repeat that. They will allow you to deduct $5 a square foot up to 300 square feet. That's a maximum deduction of $1,500. So if your home is, let's say 20, I gave you an example here. Your home is 2,500 square feet and you use 250 square feet for your home office. 10% of your home's expenses are part of your home office deduction. So you would simply multiply the 250 square feet by $5 and that gives you what? $1,250 deduction for your home office, just for the square footage. Now, there are also two categories when it comes to deductions for having a home office. You have those directly related to the home office and those indirectly related. Remember that. Two categories. One is for expenses that are directly related. The other is for expenses that are indirectly related. So let's look at the directly related. Let's say, for instance, if you paint your home office, that 250 square feet for your home office, that is fully or 100% tax deductible because it applies to your entire home office space. So you can deduct that 100%. If you paint the outside of your home, that's not directly your home office, but it's indirectly associated with your home office because your home office is inside that structure. So you're now able to deduct the allocation or the percentage. So we just said that if your house is 2,500 square feet, I want to make sure I'm explaining this in simplistic terms. If your house is 2,500 square feet and your home office is 250 square feet, you're using 10% of your housing area for your deduction, 10%. So if you paint your house, 10% of the cost for painting that house, you're able to deduct. 10% of the lawn care, you're able to deduct. 10% of the homeowners association dues. Hope you're following me. So those are your indirectly related expenses to your home-based office. You're able to deduct the percentage of the allocation. Now, what form does that go on? The home office deduction calculated on IRS form 8829. So when you meet with your accountant, that's the form 8829. And it's available again to homeowners and renters. So if you have an apartment, you're still able to launch a home-based business to minimize tax liability and to make your lifestyle tax deductible. Because think about it, use your cell phone anyway. You're just not getting the deduction. You go out to eat with your family and friends every week. You're not getting the deduction. So now your home-based business is going to allow you to take all of those expenses and deduct them. You travel with your car all through town every week outside of going to your place of employment, but you're not deducting that mileage. Now you have a home-based business, you will. Now, also part of your home-based business, the IRS will allow you to hire your children. This is a game changer. Here are the 11 steps. Number one is you need to operate as a sole proprietorship, and I'm going to talk about what that means. But you need to operate as a sole proprietor. Number two, your children need to be 7 years of age or older. Why? Because that is the case that's currently on the books with the courts. The courts have set precedents for a case where the judge granted the family, or granted during the case, the family to hire their child at age 7. The child was 7 years of age. So that particular court case set precedents. It's on the books. So you know if you hire your child at 7 and above, that you're in accordance with current court proceedings, because that case is currently on the books and have set precedents. So 7 years of age or older, hire your child in your home-based business. Number three, choose an age-appropriate job. Make sure they're doing something that's appropriate for their age. If you have a home-based business, what can they do? They can lick and stuff envelopes. You can have them answer phones. You can have them enter inventory. Whatever it is you want to have them do, make sure it's age-appropriate. Number four, prepare a job description and an employment agreement. Have them sign it. They can sign at age 7. Have them sign it, create a job description. Have them complete a W-9 with their social, and of course, if they're in elementary school, you can help them do that. You want to collect their information on a W-4, the same thing that you do with your employer, a W-9 and a W-4. You also want to open a custodial bank account. A custodial bank account is simply a bank account that's controlled by the parent. You can open a custodial bank account for your child and you control it. The IRS also wants to see that you're completing timesheets. You'll have them set up Monday through Friday, Monday through Saturday, whatever hours you set for them, and you will check that timesheet whenever you have them working. But you want to have timesheets and save those in their employee file with their W-4 and their W-9. You want to pay your child using company checks. So when you create your sole proprietorship, you can go to the bank and say, look, I want to open up a bank account and I want to do a DBA, doing business as. My wife has a bank account and she's doing business. Kimberly Thomas is doing business as an independent beauty consultant. So you can do that, doing business as. Open up a bank account and you can have checks created and you can pay your child using your company checks. Number 10, report the income on a Form 941. And those is for quarterly taxes. And of course, you can talk to your tax accountant about that and they can help you with that reporting requirement. Number 11, submit your annual reporting documentation or documents to the Internal Revenue Service. That is, again, in accordance with your tax accountant or whoever you're using for your tax services. But listen, why am I talking about hiring your children? This is a game changer. Because when you hire your child, why are you paying them? You might say, Osceola, I'm barely making it now. You're talking about us becoming financially whole when we have these debts. Where are we getting the money from to pay our children? Everything that you're currently paying for when it comes to your child will now pay for themselves using the money that's in their custodial bank account. So if you're buying your child school clothes, you will now write that child a check. It will go into their account and it will be used to purchase their school clothes. If you're buying that child groceries, yes, you hear me. If you're buying that child's groceries, it will go into you will write them a check. It will go into their custodial account and they will now be able to help out with that expense in the home. If you're paying for them to do extracurricular activities, they will now receive a check that will go into their custodial account and they can now help satisfy that expense. So now these are expenses that you're satisfying every day as a parent that now your child can help pay for because you're paying them through your home-based business. It's just that now when you pay for it every day, you can't write it off because you're doing it as a W-2 wage earner employee. Now those expenses are coming through your home-based business and you can deduct them. And here's the great thing. If the business is a sole proprietorship, I just shared that with you and I'm going to talk about that, you can deduct it. Payment for services of a child who are payments for the services of a child who are subject to income tax withholding regardless of age. So regardless of the age of the child, income taxes must be withheld, right? So if you're a home-based business and you're paying your child, income taxes still must be, you must still report that as taxable income. I'm going to talk to you about that here in a moment. Don't get confused. If you're paying your child every week or bi-weekly or every month, it must be reported as taxable income. Payments for the services of a child under 18 are not subject to Social Security and Medicare taxes. So minors don't pay Social Security or Medicare taxes, nor do they pay federal unemployment tax. So you don't have to worry about them paying those taxes. But Osceola, if I'm paying them, I still have to report that as taxable income. Yes, you do. But watch this. A sole proprietor is someone, I want to get into the definition. A sole proprietor is someone who owns an unincorporated business 100%. So you didn't file any paperwork with the Secretary of State. You're just operating as a business. Your business is you and your business is your bank account. That's a sole proprietorship. Sole proprietors have the benefit of reporting their taxes on any income earned on their personal income tax return. So if you're a sole proprietor, all of your profits and losses, all of your income are reported on your personal income tax return. Are you following me? If you are a sole proprietor, all of your income, whether it's from your W-2 wage earning employment or it's from your home-based business, it all goes onto your personal income tax return rather than filing separately as a business. So you won't have to file separate for your home-based business. Everything is reported on your personal income tax return because you are applying or you're filing as a sole proprietor. Now, if you are a sole proprietor and you hire employees, you must apply for an EIN. An EIN is a Form SS4. That's a separate identification number, separate from your Social Security number. So since you're going to be hiring your child, guess what? You need to apply for an EIN for your sole proprietorship. Let me repeat that. You need to apply for an EIN for your home-based business because you will be hiring your child as an employee. And the Internal Revenue Service states that if you're going to be hiring employees as a sole proprietorship, you need to have an EIN. Now, I just shared with you that all income must be reported as taxable income. So if you're paying your child all of this income, Osceola, I still have to report this as taxable income. So where's the advantage? Here's the advantage. Under the new tax law, the standard deduction in 2022 is $12,950. That means if your child earns less than $12,950 in 2022, they do not have to pay taxes because they will qualify for a personal exemption on their own tax return. If you pay them more than that standardized amount, you must pay unemployment tax, federal and state tax, etc. So if you pay your child through your home-based business $12,950 while you must report it as taxable income, you get the standardized deduction for that same amount. So what? It's a wash. Are you following me? You can pay that child up to $12,950, report it as taxable income, and then turn around and deduct that same amount. So now you get $12,950 as a deduction for the expenses that you would pay for your child throughout the year anyway. It's just that now you made that child an employee of your home-based business, and those funds are now being used to pay them a wage so they can satisfy their own expenses. I hope you're following that. That is a game changer. So now you have this home-based business. You're writing off your cell phone. You're writing off your mileage. You're writing off meals. You're also able to write off vacations. If you go on a vacation, you're now able to make sure that you set up an intentional meeting at your destination. And the meetings that you set up, if I am a consultant, I can set up a meeting with the hotel staff. I'm a nonprofit consultant, and I'm thinking about convening a nonprofit conference at your location. I need to meet with your concierge. I need to meet with your restaurant staff. I need to meet with your housekeeping staff, etc. Now I have a legitimate business purpose for traveling there. And I am going to meet with them. We're going to record and discuss logistics, etc. The rest of the time outside of my meeting there, guess what? I get to enjoy that location. That's the power of having a home-based business. So now you're able to make your lifestyle tax deductible. You can write off a percentage of your utilities, your water, your electricity, your internet, etc. All of this now becomes a tax deduction. So now when you do your reporting and you're looking at your tax liability, you're able to say to your accountant, these are all of my tax deductions. And those tax deductions should offset some of the taxes that you've been paying as a W-2 wage earning employee. And when the government, should the government send you back a refund, you're able now to redistribute those dollars to do what? To eliminate your debt, to build your emergency savings account, to invest for wealth. And you're doing that not having made any additional dollars through your place of employment. Any questions? Well, look in the chat. Okay, I don't have any questions. Wow, this is a good group. Okay, so for homework, I have this thing called Peek into Pink. I'm going to share with you my spouse. I had her look into a home-based business so that we could utilize that home-based business to minimize our tax liability, and we actually use it for a lot more. For those of you who do the homework and you look at this Peek into Pink and you decide this is a business that you can start for under $100 that will provide you with product and inventory to meet the litmus test of the Internal Revenue Service. For those of you that decide to do that, please let me know, because I'm going to invite you to a separate group and I'm going to show you and provide you with everything that I do to minimize tax liability for myself. And I'm going to show you how I enjoy vacations. Just came back from Hawaii. I'm going to San Francisco, to Napa Valley here shortly, staying in a 4-diamond luxury hotel. I do all of that because of how I position my lifestyle. For those of you that decide to take advantage of this Pink into Pink, or if you want to take advantage, put it in the chat. I'm going to set up a separate Zoom and I'm going to show you how to use that opportunity to really take your lifestyle to the next level. That's a fact. So family, if there are no more questions, I hope that you understand that you're positioning yourself now. Everything that I'm sharing with you, I talked to someone today who asked me about these classes, and I shared with them the goal after 10 weeks is for you to be financially whole. I'm not sharing any information that I'm not currently utilizing myself. So right now, Osceola is just about debt free. The only debt I have is this house. And my spouse and I had this house built from the ground up and paid almost half of this house before we walked into the door. So right now I'm in a good position, but I'm in a good position because the strategies that I'm sharing with you, I actually put those into practice. So I actually have more than 3 months in my emergency savings account. Why? How can I tell you to do it if I'm not doing it? So when I talk about being automated, all of my fixed expenses are automated to my credit card, my Amex Platinum card. Now, my mortgage is not. but my mortgage is tied to the lender and they take it out of my account every month. They do it every 2 weeks. Half of the mortgage is taken out of my account. So that cuts the mortgage from a 30-year mortgage down to a 24, and I pay an additional mortgage payment to take it to 20 years. So the goal is actually for me to pay it off in 18. So that comes out automatically. All of my fixed expenses go onto the American Express card, and then I take the balance out of my checking account and I dump it onto the American Express card every month, pay it off. What does that do? That just allowed us now to go away for four or five nights at a Four Diamond Hotel in San Francisco, paying nothing out of pocket. So people say, "Well, Osceola, how are you staying there?" I'm not paying for it, and I'm not doing anything extra. I'm just paying my bills every month the way you do. It's just that I have a strategy. I automate and I take advantage of the points. So when I tell you to automate your monthly fixed expenses, when I share with you to have two checking accounts and two savings accounts, and to use the right credit card. Next week, I'm going to talk to you about credit card optimization. Based on your credit score, I'm going to share with you the right credit cards to apply for and then how to use those credit cards. And you're going to use those credit cards and you're going to take the money from your checking account every month and zero that balance out. And you're going to do that each year. And every year, at the end of the year, you're going to use those dollars either to have a great Christmas or to have a family winter getaway. But you're not going to pay for it. You're going to allow the points to pay for it. That's the goal. So you're increasing your lifestyle without having to go out and work an additional place of employment. And now that you have your home-based business, especially if you take advantage of this opportunity that I'm sharing with you, peek into pink. Let me know if you want to take a look at that. You're going to use that to, number one, satisfy the IRS requirements for a home-based business. But at the same time, if you use that business, any money generated from that, you're going to take those dollars and dump that into your debt elimination strategy. You're going to take the refund from minimizing tax liability and increasing these number of tax deductions. You're going to use that as well for your debt elimination strategy and for your emergency savings account. Now, please, any questions? Who do I have on tonight? Okay. All right, family. Well, if there's no other questions, I'm going to make this PowerPoint available. I'm going to send it to you via email. But I want you to start thinking about this home-based business. If anybody has any questions about how to create a sole proprietorship, how to apply for the EIN for their sole proprietorship, please let me know, because I want to make sure that the dollars that are going out of your home are being diverted back or redirected back into your household. All right, family. God bless you and good night.